Welcome to The Explainer. We are breaking down a massive regulatory bombshell that just dropped from the European Central Bank, sending some serious shockwaves through the crypto markets. So let's get right into it. You know, this sentence right here just perfectly nails the mood right now. This is way bigger than just a dip in price. It's about a fundamental hunt for safety, because the old world of finance, well, it's officially setting its sights on the new one. And this was no minor tremor, let me tell you. On the morning of November 24th, a single report came out of Frankfurt, and it basically signaled a major offensive from one of the most powerful financial institutions on the entire planet. Okay, so what exactly was in this report from the European Central Bank that sent the entire crypto world into a panic? It all started right here, inside the ECB's regular financial stability review. Now, usually these things are pretty dry, but buried deep inside this one was a direct, and I mean potent warning, and it was aimed squarely at a really critical piece of crypto's plumbing. To really get the scale of this, we have to talk about stablecoins. So just think of them as the digital dollars of the crypto world. They're the bridges between traditional money and all these digital assets, and at least in theory, they're supposed to be a safe place to park your cash when the market gets volatile. And this quote from the report just brilliantly illustrates the ECB's absolute worst fear. They're terrified that if everybody tries to cash out of their stablecoins all at once, a classic bank run, it could force the companies that issue them to just dump all of their reserves, things like US Treasury bills. And that kind of forced selling at a huge discount, that's what's known as a fire sale. The ECB is worried that this whole cascading failure could spill over from crypto and actually destabilize traditional financial markets. So this isn't just some casual warning. It is a very clear line in the sand. They see this as a major systemic risk. So with a warning like that, how did the markets react? Well, as you can probably guess, the reaction was swift, and it was brutal. Market sentiment just cratered almost immediately. I mean, look at this. The fear and greed index absolutely plunged down to 19, which is a clear signal of extreme fear. This is what pure panic looks like in the data. People were selling first and asking questions later. And you can literally see that fear reflected in the money flows. Crypto ETFs, which are a huge gateway for mainstream investors, have seen a net outflow of over $3.5 billion this month alone. That is a massive retreat. But if you look a little closer, you start to see something really interesting. The market isn't just one big red sea. There's a clear split happening. While assets like Solana and a lot of the smaller altcoins are getting hammered, others are actually rallying hard. Zcash, Stellar, they're up. And Canton Network, a B2B token, is absolutely soaring. Now, this isn't random. There's a story unfolding here. That split, that divergence we just saw, that is the absolute key to this entire event. What you're seeing is a massive rotation of capital, a desperate search for a safe harbor right in the middle of a regulatory storm. So this is the crucial point, right? When the regulators are on the hunt, where does the smart money go? It doesn't just vanish into thin air, it finds a new, safer home. It runs towards projects that have those legal walls. We're seeing this massive flight to quality into sectors like institutional DeFi and real-world assets. Areas that tokenize things from the real world, like real estate or corporate debt, and are built with regulation in mind from day one. Money is pouring into platforms that are designed to work with the traditional financial system, not against it. So what's happening isn't just another market trend. This is the drawing of a new battle line. The ECB's move has basically just hit the fast-forward button on a split that was already happening inside the crypto world. Okay, so what we're looking at here is basically a crypto civil war playing out. On one side, you've got the original cypherpunk vision of anonymous, totally unregulated protocols. And on the other, you've got this new world of compliant, regulated platforms and stablecoins built to institutional standards, like what PayPal is doing with PYUSD. And that's really the choice the market is now facing. For a lot of projects, for a lot of investors, the path forward is becoming crystal clear. You either build those legal walls and embrace institutionalization, or you risk getting completely wiped out. And look, this whole shift isn't happening in a vacuum. It's happening just as institutional and corporate adoption is hitting a critical mass. Citing data from sources like Fidelity Digital Assets, we now have over 75 public companies holding Bitcoin on their balance sheets. The point is, the institutions are already here. And guess what? They demand a regulated playground. So, what happens now? The market is trying to digest this shock, but believe me, the real test is still to come. Let's take a look at the critical timeline for what's ahead. All right, here's what the next few days look like. Right now, the market is just trying to process all this news, all this FUD. So for the next 48 hours, I'd expect some choppy, sideways action, probably on thin liquidity. But the real landmine, that's set for this Wednesday, November 26th. On Wednesday, the U.S. Commodity Futures Trading Commission is set to release its Commitments of Traders report, and it's coming back after a temporary pause. This is a huge deal. Why? Because it's going to give us the first clear look at how the big institutional players, the real whales, have positioned their futures contracts after all this news. This data could be the very fuel that ignites the next major move. Which really just leaves us with this final thought. We are witnessing a historic collision between two worlds. Old money and new tech. The ECB has made its move, the market has responded, but this game is far, far from over. The rules for the future of money are literally being written right now, in real time, and the only question is, who's going to be left standing to write that final chapter?